Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and the major happenings in currencies. Well, joining us first up on the show is Madhavi Arora. She's Chief Economist at Emkay Global Financial Services. Madhavi, hi, thank you so much for joining in. And there's just so much happening in the international markets. I'm sure it's an everyday, a new life kind of a thing. But from where we stand at this point in time, with the tariffs on and the conversations perhaps would start with almost everybody saying that this is more noise than what we would eventually see by the time it's 2026. But until then, what is it that you're pricing in for the economy?
Hi, Manisha. So I think, as you rightly said, there's a lot of noise around this point in time. Our hope is that these punitive tariffs would be reversed by the end of the year, hopefully, and the impact on growth will be, sort of limited to that extent. If that continues to be the case in FY27, of course, we're looking at the growth hit to the extent of as high as close to 70-80 bips hit to India's GDP. As of now, we're looking at the growth impact to be largely contained under 0.2, 0.3% of GDP, owing to just US tariff, because a large part of the exports to the US also have gotten front loaded. So I think to that extent, some of the hit could be contained. And of course, almost 30% of India's export to US at this point in time are sort of insulated. But clearly, with the 50% plus punitive tariffs that we are being faced, we definitely have a massive disadvantage against our peers in Asia.
Madhavi, we've seen rupee as the worst performing currency in Asia and versus to various other currencies as well, not just versus the US dollar, but Chinese yuan and perhaps other couple currencies as well. Where is it that you see a bottom being created? How do you see this financial year ending? And also, if you can put a light on how FY27 perhaps could pan out.
See, currencies are very dramatic. It's a very difficult asset class to really take a call on. But I believe that the recent downturn that you've seen in the rupee versus emerging Asian peers is also sort of should be seen as a function of the weakness that we may probably see in our exports. So the kind of trade competitiveness that we are losing versus our peer would be taken care of by the fact that rupee would somewhere act as an offsetting factor in this. So I think to that extent, I'm not too worried on the weakness of rupee versus peers, because I think it's largely warranted to ensure that the trade competitiveness is partly taken care of. And I believe that if these punitive tariffs continue to be there on India, there would be a downward bias towards rupee versus peers, and I think that would also be something the policymakers would also want, to be very honest. So if that continues, you would see, I mean, assuming dollar, sort of remains at these current level, I think by the end of this calendar year itself, we would probably see 88.75 being crossed, because market is still pricing in, hoping for the fact that at least the additional 12% tariffs would be reversed. If that does not happen, I think 88.75 is something that I'm looking at, and policymakers also only managing the rupee volatility and not trying to change the trend of the rupee, because I think a weaker rupee is warranted in that case. Next year again would be very challenging, because as I said in the in this year we may not see growth hit owing to tariffs to the extent of say 70-80 bips, which would be the case in next calendar year. Of course, we have other tailwinds which are coming in the form of domestic demand, which could offset the growth hit because of tariffs. But I believe next year, if the tariff noise continues around the world, I think market would get a little complacent also around that, and probably will find a better equilibrium. But near term, at least next 3 to 6 months, I think if the this punitive tariff regime continues for India, I think it's advisable for us to actually have a weaker currency.
All right. There are various reports suggesting, Madhavi, that we could perhaps be back at around 86, 87 as well next year sometime. Would you believe that too?
Yeah, because as I said, markets are at this point in time pricing in a reversal. Obviously, when that happens, there would be some reversal trade or rupee trade that could play out in favor of India, and flows could also make a return. And plus, in the next, I think 6 to 12 months, you'd also say domestic demand story play out in India, which has been missing for the last 1.5 years. The problem of missing private economic agents to a large extent has been now addressed by the policymakers, and I think we would start getting the benefit of that also on growth, which could also attract some of the foreign flows. But as I said, As you get into the next year, markets would get more complacent about the tariff noise because I don't think there would be the same kind of reaction function that you had seen in the early part of this year. And thus, rupee could further get some support on those lines. So we'll see how it pans out because FX is one asset class that I think nobody really gets it right.
I would agree. Madhavi, while of course India continues to be a strong story in some sense and in some portion isolated as well. But I want to first talk about the interest rate scenario in US, and with the way that we've been looking at data, housing, credit cards, jobs, all of that much on the weaker side, there is this aggressive expectation of 2, even 3 rate cuts in this year. How are you working with, or what are you working with?
So after having seen the labor market data, which was released last week, it's sort of a seal deal that we will see the rate cuts, uh, sort of restarting in the US. There are even talks of 50 bips of rate cuts. I think there could be a consistent rate cutting cycle in the US in the next, 3 to 6 months. We'll probably see as good as 75 bips to even 100 bips of rate cut if they want to contain downside risk to growth. We also have to understand, apart from the tariff-led demand hit that US consumers will see, there's also going to be a lagged effect of the past monetary tightening that US is now going to start experiencing in growth. So I think there is a case that could be made that there could be a more consistent rate cuts that US would see, which obviously will spill over to emerging markets because a weaker dollar would augur well for EM currencies, one including that of India. Two, emerging market central banks also sort of get some more breathing space to react to the tariff hit that could impact their own external sector demand. So I think it also augurs well for the Reserve Bank of India. We've been sort of arguing that India is, or Indian policymakers have been missing the fact that there could be a massive disinflationary impulse, which could come from the fact that there's enough glut of goods in Asia, and the disinflationary impulse will come from Asia to India. Apart from the fact that the GST rationalization itself is a disinflationary force. So policymakers probably would see a much lower inflation that they have penciled in this point in time. And we have been sort of arguing for at least 50 bips of rate cut this financial year more. And if US rate cuts sort of again commence, I think it would be additional argument for us to sort of, push the Reserve Bank of India to think on a rate cut trajectory again.
Madhavi, how would you look at the India consumption story? Because the cues that you're getting in from rest of the Asia are not so great either. US is slowing. Europe has been facing its own issues there. China data we've all been looking at in any case. The Indian consumption story in the last year wasn't so great. But we do understand that by the time it was month of November 2024, the rural had started to pick up in some sense.
Correct.
But when you look at the previous quarter and the sense of this quarter, the next one is going to be even important as we look at festivals coming in. How have you seen those numbers?
See, India's consumption story has been sort of tepid for the last 2.5 years. In fact, last year was a little bit better because, as you said, the rural story picked up and urban had stabilized but at a much lower rate. I think the convergence of investment and consumption was what played out last year, where investment actually fell and consumption increased at the margin. As we are in the FY26, I think that sector rotation has continued, where consumption in India still looks to be a better play than investment. And as I said, there are multiple tailwinds that have played out in favor of consumption. Apart from the fact the rural has secularly done well in the last 9 months or so, after having largely missing in action for almost 7 years, even pre-COVID for that matter, because of 2-3 back-to-back shocks that the economy faced, from demon to GST to COVID, which decimated the unorganized rural economy. They've finally found their footing and have actually been secularly going up. And we have been sort of positive in the rural story because of the improving labor dynamics. And that has continued even in this quarter. The urban sector, I think, is a bigger problem, or has been a bigger problem, because the income effect, which has become much more dominating in terms of effect on demand. I think we will see some, we'll have to wait out for some more time to really see that turnaround. The policy impulse is pretty positive. We're seeing direct tax cuts. We're seeing indirect tax cuts, which are again regressive in nature and have been taken care of. Apart from that, the RBI's rate cuts, which I think will continue in this financial year. And, in latter half of CY26 and probably early CY27, you'll also see the pay commission impact play out largely in urban sector in the first leg. So I think eventually you will see some pickup in the urban economy. Ceteris paribus, again, we don't know what's happening on the job market owing to the external sector headwinds that we have. But if I look at the current dynamics, I think consumption is a good story to play out. Private consumption should ideally at least get some support We may not see it further worsening. For it to turn around in a more secular fashion, it will be a little bit of a lag story. But I think there are some right ingredients at this point in time which could help it turn around when the business cycles globally also turn favorably.
That point is well taken. Madhavi, thank you so much for joining in, making sense of all that's happening in the international markets. So the FY27 growth seems good. The rupee, of course, in the near term could see a decline, but the next year could be slightly positive as well. And then, of course, there's so much global cues to watch at, and that is something that we will keep an eye on. But with that, we'll go for a very short break. When we come back, we put focus on all things commodities with Peter McGuire, CEO at Trading.com. Welcome back. You're with us at Big C, and joining us now on the show is Peter McGuire. He's CEO at Trading.com Australia. Peter, hi, thank you so much for joining in. And yet another day, another record high in case of gold prices. $3,600 an ounce is done and dusted now. Are you looking at further gains from here? And what is it that you're reiterating for the gold prices by the end of this year?
Well, good afternoon, Manisha. I tell you what, if you would have said this at the start of the year when we said 3,600 was a possibility, I think everyone would have laughed at both of us. But I'll tell you, it has been dramatic, and the overall momentum, I think, is going to continue up until certainly December 31. And there's a lot of reasons for that. And I think that you've got to say 38.50 has got to be a headline, and then probably 4,000. I noticed Goldman's is saying possibly even up to 5,000. So, look, it's a runaway train at the moment. Don't stand in the front of it because it'll run you over. It's a bull market.
Oh, well, absolutely. That is very well said. Peter, at these current levels, the understanding really is that there are very less sellers into the market. People are still buying at these levels. So what are we really looking at? Many, many years of bullishness continuing? Because this can't be a short-term trend.
Absolutely. I think that's the key, Manisha. I mean, the shorts, no one's short. No one I talk to is short. No one, as far as, I mean, trading's a different matter. If you were short-term trading and you're looking at a pullback and it goes down 30 or 40 bucks, that's what a short-term trading is. But the overall momentum is certainly very bullish from here, and that will continue with central bank buying, retail sales, as far as, have a look at what's happening as far as, walking into some of those big shops in Dubai and just buying gold. It seems to be a fever pitch. You've got Costco in the States doing it. In Sydney, there are, the bullion company in Martin Place. You walk in there, I'm sure people are walking out with probably half-kilo bars of silver and gold, going down to safe deposit boxes. It's very much a part of our culture, and that won't, I don't think, wane anytime soon.
So, Peter, the sense that we're getting in from the markets is that this is less of a paper trade or a speculative trade and more of a physical trade. People really are acquiring it in physical, is it?
Absolutely. There's no doubting that. I mean, you've only got to look at what's happening across all of Asia, very much into India. And, there are paper traders out there. There's no shortage of those either, because people are prepared to ride a market up and looking for pullbacks and opportunities. They're conscious as far as fundamentals and the technicals. They're aware of seasonality demand. They're the three key drivers when you're looking at trading. Festivals, religious, all over the year. And then you're looking at what's happening as far as central bank policy, what's happening as far as inflation. And I think the US dollar coming off and so heavily off since the start of the year has really added momentum to it, Manisha.
Peter, that's about gold. And what's your sense on silver? Because $41 an ounce done, and we're looking at new 14-year highs onto this one as well. Are you looking at more gains? I mean, as you said, there would be short-term corrections that we will continue to see in all of these precious metals and commodities. But where are we ending by the end of this year?
It's got to be probably 45 and north of 45. It's too hard to go out on a limb, Manisha, with 4 months left. Anything's possible as far as price explosion to the upside. But I think 45's got to be a key handle for traders to be mindful of. And, you're nearly there now. It's what, 4150, 4160 sort of number for futures. So I think it's got the momentum to get there. We all understand from an industrial demand, we've spoken together, data centers and electric vehicles and electronics. So that's not ending anytime soon. So the overall picture, I think, is going to be first off, silver's probably got a larger percentage gain in the short term than gold. And I think many traders are very conscious of it. And, if you're a paper trader, you wouldn't like to be short at the moment.
Oh, yes. Peter, even as we're looking at very mixed data, and of course the near-term volatility in many of these base metals perhaps would also continue, have we come to a point where we do believe that the copper prices could be making newer highs in 2026 or perhaps 2027 because there are no new mines, inventories are just about hand to mouth, and we're looking at very strong demand, especially coming in from renewables?
Absolutely, and as we know, underinvestment across that whole sector for years, if not probably a decade or more. So yes, it's 9,900 on the LME at the moment. I think 9,890. So you've got to say 10.5 to 11,000 key targets, Manisha, and they might be achievable within the next 3 to 6 months. It could be there sooner. We've just got to see, as overall demand. The story hasn't changed, and I think the attraction is there. Traders like it. They trade on COMEX, and we all saw a couple of months ago what happened as far as that. It blew to the upside. But yes, it's still very, very tempting for traders to enter those markets, and I see continuation as far as bullishness across that copper market.
Peter, just coming back to metals, and platinum in the middle somewhere was making a lot of news. The way we saw 5 to 6% of gains in matter of days, and the way the interest in that had also accrued. But would you say that that light is well taken back by the gold and silver now with the kind of gains that we've seen, and platinum in sense of open interest or even volumes isn't so strong right now?
No, well, that's right. I mean, it went crazy there for a little while, and it was a nice bump to the upside for sure. But I think silver and gold took the mantle again, Manisha, and that's they're the shining stars. And traders looked at short-term opportunity again, and you can't argue with the likes what you've seen in silver from that $39 to $41 price hike, gold going from that 34 handle, now you're at 36. It's just it's electric, and people aren't going to they want to go where the strength is, and they want to go where the opportunities are, and that's what the paper market's all about. People see those opportunities and open 24 hours a day. It's been showtime, and I don't think it's going to stop anytime soon.
Peter, would you say it's safe to say that you need to be bullish in case of commodities for the near term, for longer term as well, from where we stand right now?
I think some commodities, absolutely. Some of those base metals or industrial metals, if you're looking at precious, yes. If you're looking at energy, I'm very bearish. I'm more bearish than bullish. And I think that continual downdraft is going to be into, October, November. So I'm expecting WTI to have a 5 handle. And it might be 58, 57, it might be 59, it might be 53. I don't know, but I think it's more momentum to the downside than the upside, unless you were seeing something dramatic happen from a geopolitical front. And I think that President Trump's got that pretty much under control at the moment. He certainly wants to see, and so do most countries, want to see cheaper inflation, and that's going to be a key driver. So that's a good sign for consumers and a good sign for the world, Manisha.
Peter, how would you also, you mentioned about the crude oil prices, but from here on, especially with OPEC Plus has done, trying to get back that market share, increasing production, not so much for the month of October, but definitely adding more to barrels.
Absolutely. That's what I walked away was that they're taking no prisoners. This is game on, and we're going to increase supply, roll back those cuts, and it's just going to materialise over the next matter of months. And it will continue to do that. And there may be other meetings, naturally, that come, I think they're meeting again in October, and they'll deliberate and see what the state of the play is as far as global economy, consumption, and so on. But yeah, OPEC Plus are here to stay, and they want to take more market share, and they've got the capacity to do it, Manisha.
Peter, a question on the currencies as well. Most believe, and this has been your observation as well, that going forward the dollar index could see some more further decline this year and the next as well. What currencies then are you looking at? Is it going to be euro, Japanese yen, or some of these Asian currencies? Because within the Asian currencies as well, Indian rupee has been the worst performer this year till time. How are you looking at the overall currency play up now?
Well, I want to see what happens. I mean, we're only 10 days out, 9 to 10 days out from the Fed meeting. So I want to see whether everyone's saying it's, 95% baked in, 25 basis points, but do we see 50? or do we see none? Because you've got PPI on Wednesday, CPI this Thursday, and if they were to surprise to the upside, Manisha, then that would put a handbrake or certainly change Fed Chair Powell's thoughts as far as rate cuts or the severity of them. So let's get through the next 10 days. Then I think that US dollar, if you were to see a 50 basis point cut, I think that would really push the US dollar lower from here. And maybe 25's already baked in, but it's in that 97 handle, that US dollar index. So keep an eye on euro. I think you wouldn't be surprised to see that have a little bit further bounce to the upside. Yen, of course. And when you're looking at the rupee, well, you know, you guys, 88, it's, I find it hard to believe.
Oh, well, absolutely. I take your point, Peter, that it's going to be about the US Fed meeting with it, which is this month itself. So whether it's 25 basis point, 50 basis point, the kind of guidance, statement, tone, language is something that the markets absolutely would be watching very, very keenly. Thank you, Peter McGuire, so much for joining us yet again on the show and giving us your sense on where these commodities are really going to be headed. But with that, that's all the time that we have on Big C. Thank you for watching.